There is something quietly uncomfortable about the moment you realize that the system designed to help you manage money is also the system that profits most when you can't. You have been told, at some point, that debt is a tool, that borrowing is normal, that carrying a balance is simply part of modern life, the way traffic is part of commuting, the way waiting is part of almost everything. And so you carry it. Not with alarm, but with a kind of dull acceptance, the way you accept the hum of a refrigerator you stopped hearing years ago. But here is what no one says out loud. The bank is not neutral. It is not a service provider waiting patiently for you to reach financial stability. It is a business, and its most profitable customers are not the ones who pay their balances in full every month. They are the ones who don't. They are the ones who mean to, but don't quite manage it. The ones who are close, always close, but never quite there. That is not an accident. It is, in the most precise sense of the word, a design. Picture an ordinary Tuesday evening. Someone sits at a kitchen table, a laptop open, a bill on the counter, a coffee going cold beside them. They are not in crisis. This is important. They are not behind on rent, not missing meals, not one step from catastrophe. They are, by most measures, fine. They have a job, they have a credit card they use responsibly, or at least they believe they do. They pay more than the minimum, usually. Sometimes they pay the full balance. Not every month, but often enough that they feel, broadly speaking, in control. They are not in control. They don't know this yet. They will not know it in the way a person learns something new. They will know it the way a person recognizes something they always suspected but could never quite name. A slow surfacing, like something coming up from deep water. The bill on the counter is not alarming. It is the same amount it usually is, more or less. But there is a number on it that the person never looks at carefully. A number in small print near the bottom that says something like, if you pay only the minimum payment each month, you will pay off this balance in 17 years and 4 months. The number is technically visible. It has been required by law for over a decade, but it does not register. It has never registered, because the mind does not process that number the way it processes the balance or the payment due date. The mind skips over it the way the eye skips over terms and conditions, looking for the thing that needs to be done right now and filing everything else away for later. Later, for most people, never arrives. The bank understands this better than you do. Not because the bank is sinister, but because the bank has data, decades of it. Behavioral data collected from millions of accounts, when people open their apps, what they look at first, how they respond to different kinds of messages, how they feel in different seasons, how they spend differently in January than in July. The bank is not guessing about human psychology. It is reading from a playbook built on observed human behavior at a scale that no individual can match. And what that data shows consistently is that people do not experience debt as a problem. They experience it as a weight. There is a difference. A problem is something you solve. A weight is something you carry. And the shift from one to the other happens so gradually that most people never notice the moment it occurred. When you opened that first credit card, you were thinking about the problem. You needed something, a cushion, an upgrade, a purchase you could not quite make in cash. The card was a solution. It was flexible. It was useful. It made life a little easier. And ease is something the mind files under good. The association was made before any debt existed. This card equals convenience equals good. What happened next was not dramatic. You used it. You paid it off, mostly. You used it again. The balance fluctuated but never disappeared entirely, and that became normal. That became the baseline. And here is where the psychology becomes interesting. Once a baseline is established, the mind does not evaluate it.
It only notices deviations from it. So the debt stopped registering. It became part of the furniture, the refrigerator hum, the background noise of a financial life. The bank knew this would happen. It had seen it happen 1,000,000 times before you arrived. There is a mechanism in the lending industry that almost nobody outside it discusses openly, and it is this. The most dangerous borrower from a profit perspective is the one who pays everything off every month. Banks have a name for them, an industry term that sounds almost contemptuous: deadbeats. Not because they fail to pay, but because they pay too well. They use the infrastructure, the rewards, the fraud protection, the float, and they give the bank almost nothing in return. They are, in the pure accounting sense of the word, unprofitable customers. The profitable customer is the one in the middle, not the person in genuine financial hardship. That person eventually defaults, and defaults are expensive. The profitable customer is the person who is functional, employed, reasonably stable, but permanently carrying a balance they intend to pay off someday. They pay the interest. Month after month, they pay the interest. And the interest compounds, which means the balance does not shrink the way logic would suggest. A debt that feels manageable today looks remarkably similar 12 months from now, even when you have been paying it faithfully. This is the design. Not a conspiracy, not a fraud, not anything that requires hiding. It is simply a business model built on one quiet insight. People do not understand compound interest the way they understand a price tag. If you showed someone a product that cost $400 and told them the true price was $840 by the time they finished paying for it, they would hesitate. They might put it back. But when the $400 becomes $840 slowly over 37 monthly payments, the original decision is long past. The object is in the house. The habit is formed, and the payments feel like progress even when the math says otherwise. There is something worth sitting with here, not about the bank, but about yourself, about the gap between the financial identity you carry and the financial reality you live inside. Most people believe they are reasonably good with money. They are not irrational. They do not spend wildly. They have a general sense of where their money goes and a general plan for where it should go. But there is a difference between having a relationship with money and understanding it. And what the banking system has done with extraordinary patience and precision is ensure that the gap between those two things remains wide enough to be profitable. You have been taught, mostly, to think about money in terms of how much comes in and how much goes out. Income versus expenses, a ledger. But money inside a financial system does not work like a ledger. It works like weather, invisible forces acting on your balance in ways that have nothing to do with your behavior in any given month. The interest that accrued while you were asleep, the fee that appeared because a payment cleared one day late, the promotional rate that quietly expired while you were thinking about something else. These are not accidents, they are mechanisms, and they are designed to function in the background, outside the range of your attention, because that is exactly where they are most effective. The bank does not need you to be careless, it only needs you to be slightly less attentive than the system, and the system never sleeps. This is the part where something shifts. Not dramatically, not with urgency, but in the way a room looks different once someone opens a window you didn't know was there. Understanding how the system operates does not require anger. It does not require the kind of righteous indignation that leads people to cut up cards on kitchen tables or post manifestos online about financial liberation. Those responses, while understandable, tend to collapse quickly into new patterns: austerity followed by release, restriction followed by compensation. The cycle continues, slightly louder. What changes things is something quieter. It is the moment when a person stops experiencing their financial life as something happening to them and begins observing it as something they can see clearly, in the same detached, interested way a person observes weather or traffic, not a victim of it, not at war with it, simply aware of it. When you understand that the minimum payment is not a suggestion about what you owe, it is a calculation of how long the bank can keep you paying, you stop reading it as financial guidance. When you understand that the credit score system is not a neutral assessment of your trustworthiness, but a behavioral conditioning tool that rewards certain patterns of borrowing and spending, you stop trying to optimize for it and start asking different questions. When you understand that the financial anxiety you feel at the end of certain months is not a personal failure, but a predictable response to a system designed to keep you slightly uncomfortable, comfortable enough to continue, uncomfortable enough to remain dependent, you stop taking it personally. The feelings are real.
The shame is real. The exhaustion is real. But they are not evidence of your inadequacy. They are, in many cases, evidence that the system is functioning exactly as intended. Consider for a moment the architecture of a typical bank branch. Consider where they are located: in airports, in the lobbies of large buildings, in the entrances of supermarkets. Consider what they look like inside: calm, authoritative, slightly institutional. The lighting is always a certain quality. The materials are always a certain weight. Everything communicates solidity, safety, permanence. This is not accidental design. It is a message that the environment delivers before any conversation begins. We are stable. You can trust us. Your money is safe here. And in a transactional sense, this is true. Your money is safe in the bank. The question nobody asks aloud standing in that branch is whether the bank is equally safe for your money. Whether the products being offered to you, the checking accounts, the savings rates, the credit products, are designed with your accumulation in mind or with something else. The savings rate offered by most retail banks on a standard savings account at the time most people open one is a fraction of a percent. The interest rate charged on a revolving credit balance is typically between 15 and 29%. The difference between those two numbers is not a coincidence. It is the mechanism. The bank borrows your money at near zero and lends it back to you through credit at rates that would have been considered usurious in almost any previous century. You are, in the most literal financial sense, funding part of your own debt. This is not a secret. It is in every annual report, every prospectus, every quarterly earnings call. It is stated plainly in the language of finance for anyone who reads those documents. But the gap between what is technically disclosed and what is psychologically understood is exactly where the business model lives. None of this is told to you so that you leave feeling deceived, or outraged, or energized towards some particular action. The goal is not to make you a different kind of consumer. It is not to sell you a better financial product, or a course, or a system, or a philosophy. There is no prescription at the end of this. There is only, perhaps, a slightly different quality of attention. The person who understands that the minimum payment is designed to maximize duration, that person reads their statement differently, not with panic, not with obsession, but with a kind of calm clarity. They know what they are looking at. They know what the numbers are designed to do. And that knowledge, quiet as it is, changes the texture of every financial decision they make from that point forward. Not because they are suddenly free of the system. Nobody is free of the system, but because there is a meaningful difference between being inside a system you do not understand and being inside a system you see clearly. You have always been in both kinds of rooms. You know the feeling of the first kind, the slight unease, the sense that something is slightly off, the decisions made with imperfect information in a hurry. You probably also know, somewhere in your experience, the feeling of the second kind, a situation where you understood what was happening and moved through it without fear, without confusion, with a steadiness that came not from confidence but from clarity. That steadiness is available here too, not as a destination, not as a reward for having done the right financial things, but as a mode of seeing that you carry with you into every bank lobby, every statement, every offer that arrives with friendly language and fine print. The system is still there, it will always be there, but you are no longer entirely inside it. You are also now watching it. That is where this ends, not with instructions, not with urgency, but with the quiet recognition that some things, once seen, cannot be unseen. The refrigerator hum you finally heard, the number in small print you finally read, the design you finally understood. Nothing dramatic follows from this, no immediate transformation, no sudden liberation, only a slightly different quality of attention from this point forward. And attention in a system built on inattention is a kind of power. If this landed somewhere real for you, if something here shifted even slightly, then this was worth your time and mine. There is more if you want it, other rooms in the same house, other parts of the system that work the same quiet way. The subscribe button is there if you want to come back. The comment section is there if something here is still turning over in your mind. No pressure toward either, only the standing invitation. Thank you for watching.